This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Axel Merk, President and CIO of Merk Investments, joining us today. Welcome back, Axel. It's been a year since we last had you on.
Great to be with you, Gordon.
How quickly it goes. Axel, maybe we could begin with you giving our listeners a brief overview of your background and Merk Investments and your funds.
Yes, sure. I mean, as you highlighted in the introduction, I manage an investment company. We manage 4 mutual funds that have a currency brand. I sometimes quip that 2 of them are for investors that may think we have the better printing press than the rest of the world, and 2, if one believes one has currency wars, they're more tactical. And then earlier this year, we launched a gold trust, the Merk Gold Trust, that differentiates itself from the other gold trusts that are out there, in that investors can take delivery of the gold. We hold London bars in London, and investors can take delivery. And then in addition to that, we comment a lot in the financial media, often called by journalists, get a call probably at least once a day or so by the media, and try to be an active participant and actually help people do something about the environment that we are facing.
Axel, we're here to talk about financial repression. How would you explain it to our listeners, what this macroprudential policy of financial repression is, in your words?
Well, in a nutshell, it is ways in which government is trying to deprive you of purchasing power. And not just the U.S. government, any government historically or typically, because the government has too much debt, they need to debase the value of the debt, and it's most commonly done through negative real interest rates. That's really the easiest way, but there are other ways in which financial repression can express itself. But the short of it is that the government is trying to through the back door, take some of your net worth.
Is this a transfer of wealth or destruction of wealth from savers?
Exactly. I mean, it's everything. All these policies are on the eye of the beholder. I mean, you know as much as I do how people are saying, "Oh, we don't have enough inflation in the world." Well, yes, if you have too much debt, then you don't have enough inflation in the world. But if you're a saver, then you're losing out. And so, yes, it's a wealth transfer from the savers to those that have been spending excessively and have piled up a lot of debt.
I have a lot of listeners saying, Gord, I don't understand why all the governments say they want higher inflation. I'm having troubles right now with the inflation rate I have. And by the way, I planned on retiring at 6% and I'm getting 2% or at best. They're trying to rationalize policy right now.
Well, this is the first time in history in the U.S. where both consumers, and I'm talking about everybody, not presumably listeners here, but many consumers as well as the government have too much debt. The folks who are holding that debt are foreigners for the most part, and those are not voting. And so incentives are aligned for more inflation. In fact, we have significant negative interest rates right now on a real basis. And in fact, even if one believes that we're going to start raising rates early next year, and if we had a federal funds rate at about 175 at the end of next year, my guess is we'll continue to have negative real rates. And in fact, if you go out 10 years from now, if we had a booming economy, that's probably the worst thing that could happen to us, because in a booming economy, bonds are likely to fall. If we went back to the historic cost that we have been paying on our debt, we'd be spending $1 trillion more a year just to service the interest on our debt. But fear not, that's unlikely to happen because the incentives are aligned that the Federal Reserve is going to step in to keep rates low, just as they do in Japan, and something will have to give, and that's exactly financial repression. We focus on the implications that it has on currencies and precious metals.
Axel, a lot of my listeners are having troubles grasping with the thought or the idea of negative real interest rates. It just somehow doesn't resonate with them. But that's obviously a core part of the strategy of financial repression. Could you help them with that?
Well, let's start out with something that people can relate to, like gold. Gold is a brick, a shiny brick. It's really just is a thing. It notably does not pay interest. Well, now comes your $20 note. You put your $20 note next to it. Well, the $20 note also doesn't pay you any interest. And if you want to earn interest on the $20 note, you have to put it at risk. You have to put it in the bank account. By the way, you can also do that with gold. You can lease out gold. And the hope is, of course, then when you lend somebody that money, you're going to get something in return that's worth more. So you get some interest over it, interest back, and you have, whatever, $21 a year, a couple of years down the road if you haven't, by now, not today's standards, high interest rates.
Axel, your age was showing that you used to get that kind of interest possibility. Sorry to interrupt.
Exactly. Well, the point is, of course, if prices move higher, those $21 might not buy just as much as it did when you first put the money at risk. And that's really the problem. Now, we have what's called the CPI, the Consumer Price Index, that says, inflation is pretty low. But anybody who has kids at school or has to pay health care or do many other things has realized that, the cost of living has kind of gone up. And so again, it is incentives are built into the system that show that these metrics aren't very high, but you just have to ask most people on the street, and they say, yes, their cost of living has gone up. And that's where the repression part kind of comes in. And if you think about it, over the last 10 years, real wages, meaning wages after inflation, haven't gone anywhere. People get upset. And when people get upset, they vote for more populist politicians, that we have the rise of the Tea Party, we have the rise of the Occupy Wall Street, we have the same problem in other parts of the world. In the Middle East, we have revolutions because people can't feed themselves. In Japan, you elect a populist prime minister because that guy has all the solutions, he just needs to print some money. In Ukraine, they can't balance their books, and in this case, it manifests itself differently. But it's the same sort of challenge as we have throughout the world. When we go back to talking about interest rates and negative real interest rates, we talk about it very abstractly, but it has a real impact on real lives, and people feel it. They feel repressed. That's why one talks about repression.
Now, this is not unique to just America. Most of the developed world economy with high debt levels, are they not practicing the same approach?
Yes, but there are cultural differences.
Could you help us with those?
Yes, you need to try to put yourself into the shoes of the policymakers and the citizens of the respective countries to kind of see how these dynamics may unfold differently. And in the Middle East, for example, I mentioned they start revolutions. Well, the reason they start revolutions is not because they love democracy, it's because they can't feed themselves anymore, because food and energy is a bigger part of their disposable income. Now, if you go the other direction, if you go to Germany, they, at least until a little while ago, they used to love austerity. They've thrown that by the wayside a little bit. Politically, austerity is extremely painful to deal with the sort of issues we have. In the U.S., we have a much better ability to kick the can down the road than other countries have. And boy, we've been taking advantage of that. And guess what? I think we'll continue to take advantage of that as long as we can. And so, but the short of it is that policymakers throughout the world are faced with major challenges. Throughout the globe, policymakers never blame themselves for their problems. They always blame either a minority, they blame the wealthy, or they blame other foreigners for the problems that they have. And that is why in an environment where there's too much debt, political stability is on the decline. And that is why 100 years ago, we at some point went all the way into World War II, because political stability was just on the decline, and it had, unfortunately, major implications that went way beyond it. We used to be able to say it's just money, but unfortunately it's more than just money. Axel,
where does this end, or how long does this go on, and what should we look for in the future? What's your crystal ball saying is out there?
Well, it depends on your time horizon, but in the short term, in the U.S., we are electing more populist politicians, which means it's going to be more difficult to come up with entitlement reform, which increases the odds that we'll be kicking the can down the road. We'll be relying on the central bank, on the Federal Reserve, to help us out, meaning to keep rates low. With that, to continue to have negative real rates. I don't think we can have positive real interest rates for an extended period of time in the U.S. Over the next decade. And in other environments, in Japan, for example, they are far more aggressive in their policies. They're significantly ahead of us in the game. And the challenge is, of course, that Japan is no Cyprus. The Japanese are currently moving their assets abroad. The pension fund, the $1.2 trillion government pension fund, is putting hundreds of billions into foreign stocks that they recently announced in an effort to debase their currency. And so then they can take the money back at some point in an effort to maybe have saved some money. The problem is, of course, that unless you fix the source of the issue, which starts out with getting your house in order, meaning you have to be able to balance your books before you pay interest. Once you can do that, and Greece is there, by the way, then you can say, all right, as a next step, I can write off my debt. So rationally, you could then default on your debt. In practice, that rarely happens, or usually what happens is the governments try to have inflation. Now, when you have inflation, obviously everybody is suffering in the medium term, and it feels good in the beginning. In the medium term, everybody is suffering. And as far as political fallout is concerned, we can just hope that this is going to be peaceful. But with seismic changes happening in geopolitics, you have former superpowers on the decline, new superpowers on the rise. That rarely happens peacefully. I can just hope it will happen, but unfortunately the world is not built on hopes and prayers, and neither is central banks. And you asked me earlier about my background. The reason why I started the mutual funds in 2005 is because I heard at the time a central banker say, we hope and pray that the adjustment process will be slow and gradual. And at the time he was talking about the current account deficit in the U.S. and how that may unfold for the dollar. And I said, I can't bet on hopes and prayers taking care of my finances. I got to do something about this.
You're, I would venture to say, an authority on currency wars. Did we not just take a step forward with Japan's announcements, effectively the Bank of Japan buying pretty well all the debt that's going to be newly issued and rolled over, and at the same time the pension plan, as you mentioned, is not only divesting itself of bonds, that is going from 65 down to 35%, but is buying equities and buying foreign equities. So therefore, if the yen goes down, which is clearly the strategy, they're having a store of value in other assets that are offshore. Is that a new twist? I mean, this is really strange.
It's a new twist, but just because it's a new twist doesn't mean it will work. First of all, they've only announced it. The asset prices are already going up, and they only start buying in the springtime next year. And by the way, because of the aging population, they'll be net sellers of stocks then in the long run. So this is not going to work. In the 90s, we had this discussion whether Social Security should be invested in the stock market. Cooler heads prevailed at the time because it's a zero-sum game. But there are side effects of this as well. For example, liquidity has dried up in the JGB market, in the Japanese government bond market, which means that at some point it's easier to have some sort of crisis. But the idea seems to be that, we don't need to have anybody buy the government bonds anymore because the central bank can now buy them. And so yes, this is a new level. We're at a new phase. I have indicated many times over that Mr. Abe, the Prime Minister in Japan, is likely to double down when he sees his policies are not effective, and he's done just that. And so we can just then see what the next step is going to be. The reason this doesn't work, amongst others, is that he wants to induce Japan to have structural reform. Well, you're not getting structural reform when people get a free pass. When you debase the currency to boost exports, why on earth should you reinvent yourself as a business when you can get away with the old ways that you have done business in? Conversely, in the Eurozone, for example, during the peak of the Eurozone debt crisis, the reforms that took place in the Eurozone were rather amazing. Now, clearly it wasn't perfect, but when things go well, when you print so much money that everybody feels great, why on earth should you be making the tough decisions? And that's exactly what we do in the U.S. Federal Reserve has come to the rescue, and therefore we're not tackling the big issues. But just mathematically, this cannot continue forever. And I indicated earlier, in 10 years, we might be having $1 trillion more in interest expense. By the way, that's based on numbers from the Congressional Budget Office combined with the historic rates that we've been paying on our debt. So these are not some absurd numbers. Obviously, the CBO has been wrong many times before, but still, these are things that we have to face at some point. And the way you go bankrupt is first very slowly and then at some point very fast. And so the time to prepare for any risks that come with that is now. Now, I don't know whether I'm right, but I think there's a risk that I'm right. And if so, and if people agree with that, well, what do you do? How do you go about it? And how do you prepare yourself for the scenarios that could be unfolding?
A cornerstone of financial repression is negative real interest rates. Another cornerstone is regulations and regulatories that really, in fact, ring fence you. That is, and it forces you further out on the risk curve to gain any kind of yield. Can you give us some examples of regulations and regulatories anywhere in the world that are really troubling you right now that demonstrate that?
Well, many things. First of all, regulation, in a nutshell, mostly increases the barrier to entry. If you're big enough, you might be able to deal with it. But let's take financial institutions in general. Financial institutions are in the risk-taking business. If you live in a society that's based on credit, and the entire developed world does, and if you ban risk-taking, you're going to get less economic growth. You might hate the banks as much as you want to, but if you prevent them from lending, you're not going to get growth. I mean, that's as simple as that. In my view, it is not the regulator's job to prevent anybody from making a stupid decision. Should be the regulator's job to prevent people, to prevent somebody's stupid decision from wrecking the rest of the financial system. Unfortunately, the regulations we have been introducing in recent years don't address that. And there are plenty of issues that arise in our own business. We have seen that the sort of regulations that have come in have, I believe, our investors are worse off, we are worse off, the system is less safe. It literally invites more manipulation by certain players. We've seen some of the issues flare up in the fixing scandals. I think we're going to get more of those, and we get more of those because of the regulations, because they have not been very well designed.
We have a vote coming up in Switzerland on a gold referendum. Any views on that? Not necessarily whether it'll be voted in or bent, but against, but the fact that there was enough momentum to even allow it to go to a referendum level?
Yes, we published an analysis just recently encouraging people to vote yes in Switzerland on that. At this stage, it doesn't look like it. The polls are not exactly in the favor of the yes camp. Just as a background, it's not that the Swiss have suddenly fallen in love with gold. The Swiss are fiercely independent. The Swiss like to be Switzerland. They do not like to be Germany. They do not like to be the European Union. And the Swiss National Bank, an unelected body, has imposed the euro on the Swiss, at least on a one-sided basis with the one-sided peg that it has. And the Swiss don't like that. Similarly, the Swiss obviously have been selling a lot of their gold over the last decade, and instead have been piling on euro-denominated debt, some dollar-denominated debt, and so the public has some people have said, hey, let's put a stop to that. And I think the motivations for those are the right ones. Some people like Mark Faber says, they're not moving to a full gold standard with that, so he's not going to support it publicly. But it's a backdoor way of imposing discipline on the Swiss National Bank. Clearly there will be ways that they can walk around those rules if it were to pass. But it's a very healthy way to tell them, you got to behave. You cannot just destroy the purchasing power of the people, because that's ultimately what's happening here. The savers, again, are the ones losing out with the policies of the Swiss National Bank. And my view is that an advanced economy cannot compete on price. You have to compete on adding value. And Switzerland is certainly not an economy that can compete on price. And so these policies of the Swiss National Bank are very counterproductive. Think of Switzerland having this beautiful home in a rotten neighborhood, and in order to blend in a little bit better, they have started to dump their own trash in their own backyard. And some people have said, no, we don't like that.
Axel, how does an investor protect themselves and maybe more importantly, take advantage of this investment climate and opportunity with financial repression?
I think the most important thing is that investors realize that cash is not safe anymore. Because the purchasing power of cash is at risk, negative real interest rates clearly show that cash isn't the safe haven that it used to be. Now, once you do that, I think the investment world is open. The next step is, of course, you want to invest according to the risk spectrum. And the challenge you have with equities these days is that because of the actions of central banks, not only are they elevated the prices in equities, but more importantly, everything is moving in tandem. And so getting diversification is ever more difficult. The traditional way to get diversification is to invest in bonds. Well, that has worked. Personally, I wouldn't touch bonds with a 10-foot pole in the current environment. But where do you go beyond that? And that's why we deal a lot in currencies. That's why we deal a lot in gold as well. Gold is historically shown to have a low correlation to equities. If indeed we continue to have negative real interest rates, a brick of gold is a very good competitor that pays no interest. And that is one of the reasons why we like gold. In the currency space, you can design a portfolio that has a low correlation to other currencies. Also, what you can do in the currency space is you can devise a strategy where you can be a step ahead of the policymakers, because if there's one good thing to be said about our policymakers, in my view anyway, is that they're predictable. But it doesn't mean it has to be gold. It doesn't have to be currencies. It can be many other things, real assets or other things. The important thing is that this is not an environment where people can hide. This is an environment where you have to really look under the hood, whether you truly get diversification. Don't just look at the label. And one has to be an active participant. Doesn't mean one has to be a day trader, but one has to be alert, because as much as I know that this is not likely going to have a good ending, how exactly it will morph, you can't know ahead of time. So you can only take certain risk scenarios into account and try to take them into account in your asset allocation.
So many of our listeners have believed in hard assets, specifically gold and silver, have made investments, but have found themselves very frustrated here over at least the last year and a half. Any comments or guidance to them?
Well, since 1970 until the end of the third quarter, gold had an annual return of 8%, so that's not too shabby for a brick that doesn't pay any interest. If you were to take out CPI, I don't really like doing that, but you're still at a little over 3%. But clearly, when gold goes up for 12 years in a row, some people take out leverage. And at some point, when people have to delever, you can have quite a correction on the way down. That's also why you have this disconnect between what's commonly referred to as the paper versus the physical market. That challenge exists in any market, but in the gold market, we kind of see it very explicitly. And clearly, we're in a juncture where some people think we're going to have an exit. We're going to have fabulously higher interest rates. We're going to get out of the current policies that we have. But as we talk, we just had China announced that they're lowering interest rates. Just about everybody wants to have lower interest rates. In the U.S., we talk about raising rates, but we haven't done it. In fact, on a real basis, they have continued to decline. In fact, the Federal Reserve is all but promising that rates are going to get lower. And so it's a question of, well, what do you think is going to happen going forward? Investing is always a frustrating experience because the markets will prove you wrong many times over. I happen to believe in 10 years from now, gold should be significantly higher, but I don't know what's going to happen tomorrow. Ultimately, with any investment, you should only have as much as you can sleep with at night. And I don't mean that you're physically under the pillow, but if you cannot stomach the volatility, then you're over-invested to an asset. But otherwise, gold has been a fabulous diversifier. And if you also invested in stocks, well, it's kind of fulfilling its role. One is going up and the other one is going down. Obviously, you always love it better when everything goes up. But I do think that if everything were to go up in your portfolio, you would have a significant problem at your hand, because at some point the glass is going to be half empty and you're not going to have any place to hide.
As we wrap here, Axel, are there any clear messages you'd like to leave with our listeners?
Well, be alert. Listen to reports such as yours. We publish a free newsletter. I publish things on Twitter. Come to our website and get information on that. But be alert out there and have your own opinion. If you just follow what the pundit on the news says, then you're bound to invest at the top and then sell out at the bottom. Instead, you've got to build your own framework in which to look at the world and then invest accordingly.
Axel, could you tell our listeners your website and areas that they could go to learn more about your thinking and some of your writings?
Oh, sure. Merkinvestments.com, MERKinvestments.com. Please come to our website. There you can sign up for a newsletter. Axel Merk is my Twitter handle. You can follow me there. And then obviously on our website, you can also get links to our funds, including the Merk Gold Trust that I mentioned earlier.
Axel, thank you very much for your time. I appreciate it, and I'm sure our listeners did too. Thank you very much.
My pleasure.
Talk to you again. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.